Welcome to the Deep Dive. We're here to cut through the noise and get you the core insights from key reports. And today, we're tackling something making waves, PC Jeweller Ltd's Q1 FY26 results. The growth of figures looks, well, pretty impressive. But we're not just reading headlines. We want to understand the why behind it, how a major player like PC Jeweller operates in India's really dynamic jewelry market. So our focus is squarely on their first quarter results for fiscal year 2026. That's the period ending June 30th, 2025. And we're going straight to the source material here, the company's own Q1 FY26 results presentation and their board meeting report from August 1st, 2025. Our mission really is to unpack these for you, pull out the most critical bits of information, give you that comprehensive view of what's actually going on with PC Jeweller. We're looking beyond the surface for those surprising details and insights. Think of this as your shortcut to getting properly informed, whether you track the industry closely or you're just curious about how a big name like this is doing. Right, so with that set up, let's zero in on the core financials first.
What are the top-line numbers telling us about PC Jeweller's Q1 performance? Comparing Q1 FY26 to the same quarter last year, Q1 FY25, their revenue from operations, basically sales, hit Rs 725 crores. That's up roughly 81% from Rs 401 crores last year. That's a substantial jump.
It absolutely is a really big number. And what's fascinating, like you said, isn't just that 81% revenue increase itself. It's what happens when you look a bit further down their income statement. Take gross profit, for instance. It didn't just grow, it leaped by 122%.
Wow, 122%.
Yeah, from Rs 65 crores in Q1 FY25 up to Rs 144 crores in Q1 FY26. So it tells you they're not just selling more volume, they're actually making more profit on each sale. They're selling more profitably.
Okay, so better margins there.
Exactly. That's a really key insight into how efficiently they're operating right now.
So revenue's up 81%, gross profit even more, up 122%. What else gives us a sense of their operational health?
Well, look at EBITDA. That's earnings before interest, taxes, depreciation, and amortization. It gives you a good view of core operational profitability. That surged too. It came in at Rs 210 crores for Q1 FY26.
Okay.
That's about 136% growth from the Rs 89 crores they posted in Q1 FY25.
136%. That's significant.
Very significant. It shows strong core business performance before financing costs and taxes weigh in. And then there's PBT, profit before tax, another good measure. That also saw a big jump, up around 98%, hitting our 164 crores.
And it wasn't just strong year-on-year growth. Their profit after tax, PAT, the bottom line, really that rose to Rs 164 crores in Q1 FY26 as well, which importantly is a 73% increase from the previous quarter, Q4 FY25. That was Rs 95 crores.
Right, so sequential growth too, not just year on year. That's a good sign of momentum.
And they made a point of stating their turnover is purely from domestic sales, right? No exports, no U.S. exposure.
Exactly. And that detail is quite important, especially now with, global market uncertainty. It means this impressive growth isn't getting a boost from, say, favorable currency movements or strong international demand. It's driven entirely by the Indian market, which, frankly, makes the figures even stronger.
Okay. And what about costs? Were they keeping expenses in check while driving this growth?
It seems like it. If you look at the cost drivers they mentioned, employee expenses were up slightly compared to Q1 last year, but actually down from the immediately preceding quarter, Q4 FY25.
Interesting.
And advertisement costs and other costs were also down compared to Q4 FY25. So yeah, it does suggest they're managing costs quite carefully alongside pushing for that revenue and profit growth.
So a focus on efficiency too.
It looks that way. Not just chasing sales, but managing the bottom line.
Okay, so we've kind of picked apart the numbers, and they do look impressive. But how did they achieve this? We need to understand their strategy, their place in the market.
Right. And that's where you see how they've positioned themselves. India's jewelry market is, well, unique. It's massive, obviously. But gold here isn't just, a commodity. It's deeply cultural.
Status symbol, auspicious for weddings, gifts.
Exactly. And a major way women save. The market size itself was pushing USD 70 billion back in FY23. Projections were for it to hit maybe USD 145 billion by FY28, though some say it might have already passed that by FY25. It's huge. And traditionally, it's been dominated by hundreds of thousands of small local goldsmiths, the unorganized sector, over 500,000 estimates say.
Right. So how does a big listed company like PC Jeweller compete?
Well, PC Jeweller, founded back in 2005, became one of India's largest listed retailers. They even got noticed globally. Deloitte put them in their top 100 luxury goods report in 2016, number 44, and called them one of the fastest growing.
Okay.
Their core strategy seems to be tapping into that massive shift happening in India, the move from unorganized jewelers towards organized retail chains.
Because of things like regulations, wanting quality assurance branding.
Precisely. Consumers increasingly want trust, transparency, consistent quality things that national and regional chains can offer more reliably than perhaps the small local guy. PC Jeweller seems to be positioning itself to capture that migrating customer. They're selling trust as much as jewelry.
So capitalizing on that trend. But is their approach broad or more targeted? India's market is so varied.
Oh, it's very targeted. That
Yeah.
seems to be key. They don't just have one type of store. They've got everything from flagship stores, like the big one in Carol Bagh in Delhi,
Right.
to high street locations, mass market outlets, and even a franchise model. Plus, of course, their online platform. So they cover the spectrum, from high-end bridal pieces down to everyday fashion items.
And they segment their customers too.
Absolutely. They talk about catering to the ultra-rich, think exclusive lounges. Then the rich and upper middle class, served by those high street showrooms, focusing often on wedding jewelry.
Makes sense.
Then for the middle and lower middle class, they have the mass market stores, maybe more focus on gold, and importantly, that franchise model to reach into Tier 2 and Tier 3 cities.
Ah, the franchise model. That seems smart for expansion without huge capital outlay.
Exactly. It's lower cost, scalable, and potentially offers a higher return on capital employed, ROCE. Helps them grow footprint faster in smaller cities.
They mentioned having 3 franchise showrooms currently.
Yes. And finally, for youngsters and working women, they target them with more youth-oriented designs, often in high-traffic areas, and crucially, through their e-commerce site, pcjeweller.com. That's big for lightweight, daily wear pieces.
So that online presence complements the physical stores.
Definitely. Creates those online-offline synergies, targets that growing workwear segment. So, connecting it all back, their strong Q1 isn't just luck. It seems to stem from this very deliberate, segmented strategy, tapping into India's love for jewelry across all income levels, using both physical stores and digital channels effectively.
And crucially, gaining share from that massive unorganized sector.
That's a huge underlying trend they're riding.
Okay, that strategy makes sense. But, beyond just selling jewelry day to day, there's another big piece to their story recently, isn't there? Their finances, specifically debt.
Yes, that's a really critical part of their turnaround narrative. The debt reduction has been substantial.
How substantial are we talking?
Well, they managed to cut their outstanding bank debt by over 50% just in the last fiscal year, FY24-25.
Over half. Wow.
And they didn't stop there. In Q1 of this year, FY26, they reduced it by another, 8.7%?
Right.
And then another 10.1% reduction just in July 2025.
So they're aggressively paying it down.
Extremely aggressively. Their stated goal, their key target, is to be completely debt-free by the end of this fiscal year, FY26.
That is a huge commitment for a company this size. And presumably, fundraising has helped fuel this.
Absolutely. They had that big preferential issue of fully convertible warrants last fiscal year. Raised Rs 2,702 crores.
And the subscription rate was very high, right? Of 99.89%.
Phenomenal subscription rate. It really showed strong investor confidence at the time.
Can you briefly explain for listeners what warrants are and why use them?
Sure. Warrants essentially give investors the right, but not the obligation, to buy company shares at a set price within a certain time frame. For the company, it's a way to raise capital now, maybe with less immediate dilution than selling shares directly. The high uptake here suggests investors believed in the future share price potential.
So it signals confidence. And they've raised more recently, too.
Yes, the board approved raising another Rs 500 crores or so via preferential allotment just on July 10th, 2025. So continued ability to attract funds.
All this strengthens their financial position significantly.
Hugely. Getting debt off the books, combined with successful fundraising, it signals a company really getting its financial house in order, preparing for perhaps a new growth phase.
Operationally, they still have a decent network. 51 showrooms as of June 30th, 48 owned, 3 franchisee across 37 cities, though they did close 1 store in Jamshedpur during the quarter.
Right. And they also did that share split, remember?
Ah, yes, the stock split. Face value from Rs 10 down to Re 1. That was back in December 2024.
which had the effect of increasing the number of shares dramatically, making them more accessible, and they reported a 91% increase in the total number of shareholders afterwards.
So wider retail participation potentially.
Potentially. It all feeds into this picture of proactive financial management, and they emphasize their core strengths. Manufacturing, design, staff, customer policies remain intact. So combining that operational base with the stronger finances, you can see why they sound optimistic.
Their outlook seems to be focused on regaining market share, improving operations.
Yes, they talk about regaining lost share, hitting higher business levels once they're debt-free. They expect no more finance costs then and funding working capital from operations. They anticipate better operational momentum, renewed market engagement, sustainable growth. It's a confident message.
That goal of regaining market share is interesting. They did face challenges that led to losing some ground, right? How tough will that be against competitors?
That's a very fair point. It's certainly not guaranteed. Competition is intense. But their argument would be, I think, that shedding the debt burden removes a massive distraction and financial drain. And they mention revamped showrooms and a renewed marketing push. So the tools for a comeback might be stronger now. It's about execution, really, and focusing on business development, brand presence, managing overheads better.
Okay. So we've laid out a pretty positive case here. Strong results, clear strategy, major financial turnaround underway.
Yeah.
But for a truly deep dive, we have to look at everything. And that means looking at the statutory auditor's report. They issued something called a modified review conclusion. This part is really key for anyone wanting the full picture, warts and all.
Absolutely essential. You can't just look at the company's narrative. The auditor's view provides critical context. So yes, while the board approved the Q1 results, the auditors flagged a few specific issues where they couldn't give a completely clean or unqualified opinion.
What was the first point?
The first one relates back to FY 2019. Export discounts. PC Jeweller gave about RR's 514 crores in discounts to export customers back then. Now, they've apparently got approvals for a large chunk of that, around Rs 330 crores.
Okay.
But for the remaining amount, about Rs 183 crores, the necessary approvals and supporting evidence are still pending after all this time.
Still pending from FY19.
Apparently so. And because of that, the auditor says they can't comment on what impact, if any, this might have on the financials. The company itself says they don't expect any material penalty, but the documentation gap is what the auditor is highlighting.
Right. A lack of sufficient audit evidence on that specific historical item. What's the second point?
The second issue also relates to exports. Overdue trade receivables, money owed to the company by export customers. As of June 30th this year, there was a very large amount, Rs 1,592 crores outstanding from these export customers, overdue for more than 9 months.
1,592 crores. That's a huge number.
It is. Now, the company has accounted for some potential losses here. They've applied what's called an expected credit loss, or ECL provision. That provision stood at about Rs 184 crores as of June 30th.
Okay, so they've set aside something for potential non-payment.
Yes, but here's the auditor's point. They noted that none of this overdue money has actually been collected according to the expected repayment schedules. And because of that lack of realization, the auditor couldn't assess if that Rs 184 crore provision is actually adequate, or what the impact might be if it's not.
So uncertainty around the collectability of a very large receivable.
Exactly. Again, the company states they think any penalties are unascertainable but not material, but the auditor highlights the uncertainty and lack of realization.
And there was a third point the auditors raised.
Yes, the third point concerns inventory. Some of the company's stock has been under court custody since January 2023.
Under court custody.
Yes. And crucially, neither the company management nor the auditors have been able to physically verify this specific stock.
Physical verification is usually a standard audit procedure for inventory.
It is. Its release apparently depends on fulfilling terms of some joint settlement agreement. And its value in the accounts is based on the management's own determination, since it couldn't be physically checked or independently valued easily.
Okay, so another area where standard verification wasn't possible.
Correct. The auditors also drew attention, under emphasis of matter, to a couple of other things, like the successful completion of that big warrant issue we discussed.
Right.
And the fact that the company continues to recognize financial liabilities where the lender's recorded balance might differ. Just things to note.
And procedurally, they also noted the board approved appointing new secretarial auditors, Ms. R.S. Sharma and Associates, subject to shareholder approval.
Right. So Stepping back, what does all this mean for you, the listener? These auditor qualifications aren't just technicalities. They point to real areas of uncertainty or unresolved issues.
They seem mostly historical, related to those past export dealings.
Largely, yes. The discounts and receivables issues stem from past export business. It suggests some lingering risks or complexities from that period, even if the company feels the eventual impact won't be material. And the inventory under court custody, that's a direct limitation on verifying a portion of their assets right now. It adds a layer of caution needed when interpreting those strong headline financial numbers.
It definitely complicates the picture.
It does. It reminds us that even when current performance looks good, past issues can cast a shadow until they're fully resolved.
So wrapping this up, we've really explored two sides of the coin today. On one side, you have these very robust Q1 FY26 financials. Strong growth, improving profitability, a clear strategy focused on the domestic market and shifting consumer preferences, and a major financial turnaround underway with aggressive debt reduction and successful fundraising, a very positive narrative.
Definitely. A picture of a company potentially staging a strong comeback.
But then, on the other side, juxtaposed against that, you have the statutory auditor's modified conclusion, highlighting these specific lingering uncertainties around historical export transactions, those discounts and massive overdue receivables, and that inventory under court custody that hasn't been physically verified.
And remember, understanding a company properly isn't just about celebrating the good numbers. It's about seeing the whole picture, appreciating the complexities, the risks, the historical baggage. All the things that a deep dive into the actual source documents reveals.
So as PC Jeweller pushes towards that debt-free goal by FY26, aiming to win back market share, the real question for you to think about is this. How much weight should you give those historical audit qualifications, those lingering uncertainties, when you weigh them against the current strong performance and the ambitious plans for the future? And looking ahead, what will be the key sign, the critical indicator, that truly signals whether PC Jeweller is on a sustainable, long-term positive trajectory? That's something to keep watching.